There is a sales pitch so well constructed, so emotionally airtight, and so deeply embedded in American financial culture that millions of people hear it every single year and walk away convinced they just made a smart decision. The pitch usually starts with your mortality, pivots to your family's safety, and ends with you signing a contract you don't fully understand for a product you probably don't need, managed by a company whose incentives are almost perfectly misaligned with yours. I'm talking about whole life insurance and permanent life insurance in general. The category that includes whole life, universal life, variable life, and indexed universal life. Products that collectively pull in over $180 billion in premiums annually in the United States alone. And look, before the insurance agents in the comments start warming up their keyboards, let me be clear. Term life insurance is fine. It is simple, transparent, and does exactly what insurance is supposed to do. You pay a premium. If you die during the term, your family gets paid. If you don't die, the policy expires. Clean, honest, boring. This video is not about term life. This video is about the other thing, the thing that gets sold at kitchen tables and in office parks and over lunch by people who call themselves financial advisors, but are actually licensed insurance agents operating on commission structures that would make a used car dealer uncomfortable. The thing that gets marketed as protection and savings and an investment and a tax shelter and a legacy tool all rolled into one. Because here's the thing. When something claims to do 5 jobs at once, it usually does all 5 of them worse than 5 separate things built to do one job each. Let's start with how it's supposed to work, because the concept isn't completely insane on its face. A whole life insurance policy charges you a premium, typically much higher than term, and splits that premium into 2 buckets. One bucket funds the death benefit, the actual insurance portion. The other bucket goes into something called the cash value, which grows over time on a tax-deferred basis and can theoretically be borrowed against or surrendered for cash later. The agent sells this as building equity in your policy, which sounds like building equity in a home, which sounds like a good thing, which is exactly why they use that framing. Here's what they don't say at the kitchen table. In the first several years of a whole life policy, typically the first 2 to 3 years, sometimes longer, almost none of your premium goes to cash value. It goes to something called the surrender charge and the agent commission. And the commission on a whole life policy is not a modest percentage. It can be 50% to 100% of your first year's premium paid out to the agent on day one. On a policy with a $10,000 annual premium, the agent may collect $8,000 to $10,000 in the first year. Your cash value at the end of year one? Often less than $1,000. You just handed someone a 10 times commission on a financial product tied to your family's future. Let that sink in. A 401k advisor charging 1% feels predatory. A whole life agent collecting 80% of your first year's premium in commission before your policy has earned a single dollar of real return is a different category entirely. Now let's talk about the returns, because the insurance industry will tell you the cash value grows safely and guaranteed. And that's technically true. The guaranteed growth rate on a typical whole life policy is somewhere between 1.5% and 2.5% annually. In an environment where a basic S&P 500 index fund has averaged roughly 10% annually over the last 50 years, and a 10-year U.S. Treasury bond currently yields around 4.5%, a guaranteed 2% on a product with an 80% first-year cost structure, is not a savings vehicle. It's a storage unit for your money with a lock on the outside and a slow drain in the floor. But here's where it gets more sophisticated, because the industry has gotten smarter about the criticism. Enter the Indexed Universal Life Policy, or IUL. The IUL was engineered as a response to the whole life has terrible returns problem. It promises upside participation in a stock market index, usually the S&P 500, while protecting you from losses with a floor, typically 0%. Sounds incredible. Market upside, zero downside. The financial equivalent of betting on a coin flip where heads you win and tails you don't lose. The mechanism that makes this work is called the participation rate and the cap rate. The participation rate is the percentage of the index's gain you actually receive. The cap rate is the maximum gain you can capture in any given year. A typical IUL might have a 100% participation rate, but a 10% to 12% annual cap, meaning in a year where the S&P 500 returns 25%, like it did in 2023, you get credited 10% to 12%. In a year where it returns 8%, you get most of that. In a year where it falls 20%, you get 0% credited. Not a loss, a 0%. Which sounds like protection, but is actually the insurance company absorbing your floor in exchange for your ceiling. They keep the volatility. You keep the illusion of participation. Now layer the actual internal costs on top of that. IULs charge a cost of insurance that increases as you age, administrative fees, rider fees, and sometimes a mortality and expense charge. In a bad sequence of years, moderate market returns combined with rising internal costs as you get older, the policy can actually lapse. Your death benefit disappears. Your cash value disappears. And you get a tax bill because the gains you borrowed against are now considered a distribution. A product sold on the promise of protection can, under the wrong conditions, leave you with nothing. Not underperformance. Nothing. Here's the historical rhyme that should make you deeply uncomfortable. In the 1980s, universal life policies were sold en masse during a high interest rate environment. The illustrated returns looked extraordinary because they were projected using interest rates of 10% to 12%. Then, interest rates fell. The policies couldn't sustain the illustrated growth. Policyholders started receiving notices that their premiums needed to double to keep the policy alive. Class action lawsuits followed. The industry paid out billions in settlements and quietly redesigned the product. They called the new version Universal Life 2.0. They changed the interest crediting mechanism. They added more complexity. And then they sold it again. History doesn't repeat, but the lapse notices do. The mechanism powering all of this is the same one that runs through every story on this channel. Complexity as a weapon. When a product is simple, a consumer can evaluate it. When a product has a participation rate, a cap rate, a floor, a cost of insurance, a surrender charge schedule, a loan provision, a corridor requirement, and an illustration that shows hypothetical returns for 40 years, the consumer can't evaluate it. And when a consumer can evaluate it, the person selling it, who earns 80% of your first-year premium, has almost unlimited room to operate. The industry knows this. A 2023 study found that fewer than 15% of permanent life insurance buyers fully understood the fee structure of the product they purchased. Fewer than 15% on a contract they signed, for a product they'll pay into for decades. So what should you actually do? Here's the short version. If you need life insurance for income replacement, to protect a spouse, kids, or dependents, buy term. A 20-year level term policy for a healthy 35-year-old costs roughly $30 to $50 per month. That's it. Clean, transparent, done. If someone is pitching you whole life as an investment or a retirement vehicle, ask them to show you the internal rate of return, not the illustrated return. The actual IRR, accounting for all costs, fees, and commissions. Watch what happens. Compare the buy term and invest the difference math. Take the premium difference between whole life and term, invest it in a low-cost index fund, and model it over 30 years. In the vast majority of cases, the index fund wins by a number that will make you angry. If you've already been sold a permanent policy and you're within the first 3 years, talk to a fee-only financial planner, not an insurance agent, about whether surrendering makes sense. The math changes significantly depending on where you are in the surrender charge schedule. If someone describes an insurance product using more than 4 words of jargon in a single sentence, that jargon is doing a job. Figure out what job before you sign anything. And here's the uncomfortable truth. The life insurance industry is not populated by villains. Most agents genuinely believe in what they're selling because they were trained by companies that profit from them believing it. The whole system, the training, the culture, the language, the illustrations, is architected to produce enthusiastic, sincere salespeople who can sit across from a grieving widow hypothetical and make permanent insurance feel like love. And that sincerity is the product. The emotional resonance is the distribution mechanism. And the $180 billion in annual premiums is the outcome. You are not being sold a financial product. You are being sold a feeling. And feelings don't have expense ratios printed on the back. So drop your take in the comments. Do you think permanent life insurance is A, genuinely useful for a specific segment of the population and just badly missold to everyone else? B, a structurally broken product that should face far more regulatory scrutiny? Or C, working exactly as designed, just not for the person buying it? Because the only thing more expensive than bad insurance is the false sense of security it leaves behind. And the best financial protection you'll ever have is understanding exactly what you're paying for